Hello everyone, here is a quick review assignment for AC201 for Unit 1 of AC201. In this assignment we are going to do some adjusting entries. We are going to compute our adjusted trial balance so we can prepare our financials, and after our financials are made we're going to prepare our closing entries and a post-closing trial balance. Our first adjusting entry is the adjustment for the expiration of prepaid assets. On January 1st of 2023, Mayweather Car Detailing is going to prepay $4,800 for a one-year insurance policy, which expires on December 31st of 2023. We're going to do the adjustment for this prepaid asset at the end of the first quarter, or March 31st, if you will. So at the beginning of the year, we put 12 months worth of insurance on our books, prepaid for $4,800. When the first quarter ends on March 31st, 1/4 of that prepayment will have expired at that time. So how much do we need to adjust for? Well, let's do some simple calculations. The original prepayment amount given in our information is $4,800. This $4,800 was paid for a one-year insurance policy, so that's 12 months. Which means if we were going to remove this prepaid asset from our books and expense it at a straight line rate, if you will, at the same amount every single month, we should be expensing this prepayment for insurance at a rate of $400 per month. If we bought the policy on January 1st and we are adjusting on March 31st, all of January, February, and March have expired. Therefore, the number of months that have expired are going to be 3. And if we are expensing this prepayment at a rate of $400 per month, and 3 months have passed, 400 times 3 equals 1,200. So we need to record an actual expense for this insurance equal to that $1,200, and we need to decrease the amount of prepayment we have for insurance on our books by that same $1,200. So on March 31st in our journal entry, we are going to record a debit to insurance expense. This account is being debited because insurance expense, like all expense accounts, goes up on the debit side for the $1,200. And we are going to decrease our prepaid insurance account by that same $1,200 in this journal entry where we adjusted for prepaid asset expiration. Another common adjusting entry for companies is the adjustment for supplies used. On March 31st of 2023, Mayweather Car Detailing is going to send an entry-level employee into the storage area to do a physical count of the company's cleaning supplies that are on hand at the end of the period. Common practice, I have been that entry-level employee before. You send somebody in to where you keep all of your supplies that you need to do your job function, and that person goes through and takes a physical count of every little thing that you have in there to determine what is the total value of the supplies that you have on hand. And this person who did the physical count decided that there was $5,100 worth of cleaning supplies in the storage room at the time of the count, March 31st. You don't expense supplies each and every time you use up a supply. That would be madness to have to take off 90 cents from your supplies because you used a roll of paper towels. Like, that would just be nuts. So basically what you do is whenever you purchase them, you put them on your books, and at the end of the period you go through and figure out what you still have, and the difference between those two numbers is how much you expended. Well, our books say that we have $8,000 worth of supplies. Again, every time we purchased it, we put it on the books. That basically means had we not used any supplies, we should have $8,000 worth of supplies on hand at this time. But we don't, because our physical count revealed that we only have $5,100 worth of supplies remaining. Well, if we could have had $8,000, but we only have $5,100 left, what did we actually use? What's the amount of the adjustment? It's the difference between these two numbers, which is $2,900. So in our adjusting entry, we are going to debit supplies expense to recognize the amount of supplies that we expended doing our job, detailing cars during the period. And now we need to decrease our supplies account so it's down to what we actually physically have on hand. We do that with a credit to supplies, because like all asset accounts, supplies decreases on the credit side for $2,900. And we adjusted for supplies used during the period. Every company that has equipment, vehicles, long-held assets that they're going to use on the regular to do their job function is going to have to account for depreciation. GAAP's historical cost principle says you can't expense the purchase of any long-held asset. At the time of purchase, you need to come up with some kind of system to remove its value little by little over time during its useful life. For Merriweather Car Detailing, their cleaning equipment is one of those depreciable assets. On January 1st of 2023, they purchased $6,800 worth of cleaning equipment. That is the historical cost of those assets. Do we have to take $6,800 away in value? No, we don't, because it's reasonable to expect that that equipment that they have, they're going to be able to sell to somebody else, or at least they're going to be able to scrap it because it's metal for scrap metal prices. So when you make that purchase, you estimate how long you're going to use it for and how much you think you're going to be able to resell it or salvage it for at the end of its useful life. And Merriweather is estimating that this is going to be useful for a period of 5 years and that they'll be able to resell this equipment for $800 at the end of its life. Which in other words means we need to remove an amount of value from this cleaning equipment for the difference between what it was worth on day one when we bought it, $6,800, and what it's going to be worth at the end of its life. Well, that is just the difference between its historical cost and its residual value. If it was worth $6,800 on day one, and it's going to be worth $800 at the end of 5 years, the amount of value we need to take away from it, or its depreciation base, is $6,000. How we get rid of that depends on what methodology we use. For this particular example, we're going to use what is, in my opinion, the easiest one, straight line depreciation. We're going to take it off in equal chunks. If we have this for 5 years, and there's 12 months in a year, we're going to be using this asset for a grand total of 60 months. If we need to remove that $6,000 from value over the span of 60 months, well, if you just take $6,000 and divide it by 60, you come up with $100 per month. If we depreciate this cleaning equipment at a rate of $100 per month for the next 5 years, it's going to reduce its book value from its $6,800 historical cost down to its $800 residual value. We're making this adjustment on March 31st of 2023. How many months do we have to depreciate for? Well, if we bought it on January 1st and it's now March 31st, that is January, February, March. That is 3 months. Which means over the first quarter of 2023, our equipment will have lost $300 in value. 100 times 3. So in our adjusting entry to record this asset depreciation, we are going to debit depreciation expense. And we are going to credit our accumulated depreciation account, which I shortened to ACDEP, and it's good form to put dash what type of asset is being depreciated. In this case, it is equipment. And we are crediting that account because it is a contra asset account, and contra asset accounts go up on the credit side, and that's going to be for the $300 that we have for the adjustment. And here we can say that we adjusted for quarterly asset depreciation. A lot of businesses will do, especially service businesses, will do business on contracts. There are usually terms within that contract of when those services are to be provided and when payment is going to be transferred. In this first example, we're going to have some deferred revenues, which means we're getting paid in advance, we're getting advance payment, but we're going to defer recognizing that revenue on our books until we actually perform the services. On February 1st of 2023, Merriweather Car Detailing is going to enter into a 6-month contract to detail buses for Bernard Bus Incorporated. The stated contract amount for these future services is $4,200, and Bernard Bus Incorporated is going to pay Merriweather this full amount in advance. So we're getting all the money before we provide even a single service. And they did so when we signed the contract on February 1st. The total advance payment, we have that for our calculations, is $4,200. During the time that has passed since we signed this, Meriwether has met their performance obligations for this contract during the months of February and March. We need to record an entry to recognize the fact that while we've not done all of the work which we were prepaid for in this 6-month contract, we have done some of it, 2 months worth. So how much are we going to recognize? Well, let's figure this out on a rate basis. If we're getting $4,200 for a contract that is expected to take us 6 months to complete, and we're going to recognize revenues in a straight line, that means we should be recognizing $700 worth of actual revenue per month for this contract. We're making this adjustment on March 31st. We started working on this on February 1st. We met all of our obligations for those 2 months of February and March. So we need to put 2 months worth of actual earned revenues on our books for this contract. And if we're recognizing at a rate of $700 per month, that means that we have $1,400 worth of service revenue that we can actually put on our books because we have met our obligations. We have detailed Bernard's buses. So on March 31st, we're going to make one more adjusting entry. The first account that we're going to use is unearned revenue. Why would we use unearned revenue? Because we got paid in advance for revenue which we had not yet earned. We had not performed the services. Well, now we have performed some of those services. We don't owe them as much work in the future, which means we need to reduce our liability to Bernard Bus. And like all liability accounts, unearned revenue goes down with a debit. So we're going to debit unearned revenue for $1,400. And now that we've actually performed our obligations, we can record this as service revenue and adhere with that good old GAAP revenue recognition principle. So we're going to debit unearned revenue for $1,400. We're going to credit service revenue for $1,400. In this entry where we adjusted for deferred revenues earned on contract. In our next entry, we have another contract, but this one's going to work the other way around. On March 1st of 2023, Meriwether Car Detailing is going to enter into a contract to detail an entire fleet of delivery vehicles for Rainforest Incorporated. Both of these parties, at the time that we entered into this contract, have agreed that the entire job is going to take 2 months to complete, and at the end of the 2 months, after we're done detailing all of these delivery vehicles, they're going to be picked up by Rainforest Incorporated on April 30th. Well, Rainforest has agreed to pay Meriwether $5,000, but they're going to pay this full contract amount at the time the detailed vehicles are going to be picked up, which right here is stated it's the end of the contract, which means we are going to work and detail all of these delivery vehicles for Rainforest Incorporated, and we're not going to see a single penny until the end of this contract's life. I think it's fair to say that if for some reason Rainforest Incorporated wanted to terminate this contract early, and we are going to, and they were going to want to take their fleet back. If we've detailed some of the vehicles in this fleet, we're going to charge them for at least a part of that $5,000 because we did some of the work. So even though we're not getting payment until the end, we should be recognizing revenue as we actually earning it, and we should be changing our books to recognize the fact that even if they want to get out of this, Rainforest still owes us money because we did some of the work. So let's figure out how much we need to adjust for. Well, the total amount of this deferred payment contract, as stated above, is $5,000, as we're going to get at the end of April. Both parties have agreed that this is going to take 2 months to do, so there's 2 periods in the contract. If we recognize this, therefore, in a straight line, we should be recognizing at a rate of $2,500 per month. We signed this contract on March 1st. Like all of our other adjustments, we're adjusting at the end of the quarter on March 31st, which means we did all our work during the month of March. We met all our obligations, and therefore we should be recognizing 1 month's worth of actual earned revenues on this contract. So the amount of our adjustment is just $2,500 times 1, or simple math tells us 2,500. So what is the journal entry that I need to put on the books here? Well, on March 31st, I'm going to debit accounts receivable. Because just like I said before, if they call us on April 1st and said, we don't want you to finish that, we're going to come pick up our fleet now, that's fine with us, but we're going to make sure that they pay us what they owe us for the work that we have done, which we just determined was $2,500 worth of work. Since we met all the obligations of the contract, they owe that money to us right now, regardless of what they want to do in the future. Since they owe it to us, we're going to receive it in the future. We put it on the books as an accounts receivable. And we actually performed the obligations, provided these services, which means our service revenue account has to go up as well. Even though we're not getting paid for it until next month, we earned it during the month of March, which means it's got to go on the books during March to adhere with that revenue recognition principle. And here we adjusted for accrued revenues earned on contract. So why is this one deferred revenues and this one's accrued revenues? Well, the previous one, it's deferred revenues because we got the money first and we're deferring recognition of those revenues until we actually perform the services. On this one, we're performing the services first and we're going to accrue all of those revenues and that receivable until we're done with the contract, and then we get payment at the end. So deferred, in short, means money first, revenue later. Accrued means revenue first, money at the end. Anybody who has debt, which is pretty much every business, is always going to have to make an adjustment for the amount of interest which is accrued on the debt at the time that you are preparing your books to make financial statements. On March 31st of 2023, Meriwether Car Detailing is going to sign a $10,000 12% 10 months note payable with Capstone Lending. Under the terms of this borrowing, Meriwether is going to repay the entire $10,000 they borrowed plus all accumulated interest on January 31st of 2024, which is 10 months from the day that we signed it. This is common for business loans. I know, and for most people, for most private citizens, consumers, if you will, when you take out a loan, they give you a monthly payment that you have to pay every month. It has a portion that goes towards principal and a portion that goes towards interest. In the business world, if you're taking a short-term loan like this, you won't have to make regular monthly payments. You get a big blast balloon payment, as they call them, at the end that you have to pay, plus all the interest that is added up. So we're not actually paying anything to Capstone Lending right now. We're recognizing the fact that we've had this loan for a while, and even if we wanted to pay it off early, Capstone's going to make us pay more than the $10,000 back. We're going to have to pay at least a portion of that interest that is accumulated on this note. So how do we figure that out? Well, let's take our outstanding principal balance. We borrowed $10,000. We've not repaid any principal, so our outstanding principal balance at the time we're making this adjustment is $10,000. We're going to take the stated interest rate, which in our case is 12%. And if we multiply the outstanding balance of our note times that stated interest rate, we get the annual amount of interest that we'll have accumulated on this note. For borrowing, the percentages that are stated have to always be expressed in terms of APR, annual percentage rate for the year. You can't have like 3% over the next 2 months. It just gets too confusing when you have different percentages for different time periods. It's going to cause people to take out loans and not realize how much they're actually paying. They set the rules that say all interest rates have to be stated for the year. So we would have to pay $1,200 if we had this loan for an entire year, but we haven't had it for a whole entire year. What have we had it for? Well, we took it out on March 1st. We're adjusting on March 31st. Only 1 month has passed. So if we paid this off early, we wouldn't owe a full year's worth of interest. We would owe 1/12 of that because 1 month out of the year has passed. And if we take $1,200 and multiply it by 1/12, we come up with $100, which is telling us if we wanted to pay this off early, Capstone Lending, if you want to pay it off tomorrow on April 1st, Capstone Lending would say, all right, give us our $10,000, but you also owe us an extra $100 for the interest that is accumulated on this note. So when we make our adjustment on March 31st, we're going to recognize that interest expense because you recognize expenses in the period that they actually happened. We accrued this interest during March in this case. We need to put it on the books for that same period. So we're going to debit interest expense for $100. Since we're not actually paying anything to Capstone Lending until January 31st of 2024 when this note becomes due, we're not going to credit cash. No money's getting transferred. What we need to credit here is the fact that we know we owe them $100 worth of interest. we're liable to pay them that $100 worth of interest. It's a liability account. It is interest payable. So we're going to credit interest payable for that same 100 when we adjusted for interest accrued on the note. Another very common adjustment is the adjustment for salaries and wages owed to employees. Typically, a period, an accounting period, a quarter if you will, doesn't end on payday. Like when your accounting period ends, you're going to have employees who have probably worked a few days since they've last been paid. Well, the expense related to those salaries needs to go on the books in the same period that they actually worked, that it happened, which means even in our case, if our employees aren't going to get paid until April, if some of those days occurred during March, they need to go on the first quarter's books. All of our employees are on salary, and they get paid bi-weekly, which is a 10-day work period, 2 5-day weeks, if you will. The normal salary and wages that we pay to all our employees for each pay period is $2,200. So we have our normal wages during a pay period, $2,200. The month of March is going to end on the Wednesday immediately following a payday. That means our employees have worked a Monday, a Tuesday, and a Wednesday in March since they've last been paid. Since those days were worked in March, we're going to have to put 3 days worth of typical pay on our books as an expense to adhere to that GAAP expense recognition principle. Well, to figure out how much we need for 3 days, we need to first figure out how much we normally pay our employees each and every day. Well, if they typically make $2,200 for each 10-day biweekly period, we can divide that $2,200 by 10 and come up with $220. We typically pay our employees $220 per day. Yes, we don't pay them every day, but like on a rate basis, that's how much our employees earn each day. And if we owe them for 3 days, and they typically make $220 per day, that means that we owe them a grand total of $660 for wages for days that they've worked during the period but have not yet been paid. So on March 31st, we are going to debit salaries and wages expense account going up for that $660. Now we have all of our salary related expense which occurred during the first quarter on the books for our first quarter. And since we're not actually paying this until a later date, we are going to credit salaries and wages payable for that same $660. And I'm going to say here in our description that we adjusted for salaries owed. And we've got one more adjustment to make for Merriweather. This one is for our bad debt allowance. Merriweather uses the percent of receivables method for estimating its bad debt and maintaining an allowance for that bad debt. Again, under GAAP, we have to make a reasonable estimate of what portion of our receivables we don't expect to ever see, or what's going to be our bad debt. And when we report the amount of receivables we have on our books, we don't report it at just the overall gross value, but the amount that we actually expect to realize, the amount that we expect to convert to cash. There's different methodologies for doing that. Merriweather right here is going to use the percent of receivables method. So as of March 31st, 2023, Merriweather Card Detailing's accounts receivable account has a balance of $6,000. That is the book balance of our receivables. We're going to estimate what percent of those receivables we think are going to prove to be uncollectible, and after some quick math, our accountants have determined that we think 3% of those receivables are bad debt. Well, if we think 3% of our $6,000 receivables are bad debt, what is the actual dollar amount of that bad debt? 6,000 times 3%. 180. We think we have $180 worth of bad debt on our books. When you're using the percent of receivables method, you have like a running balance in that account, which you're always adjusting to its target. We just determine our target. We need to do whatever we have to do to the current balance of our allowance for bad debts to get it up to, or maybe down to, in some cases, $180. Well, what do we currently have in there? our allowance for bad debt account currently has a book balance of $110. Well, if we have $110 in there and we need to get it up to $180, how much do we have to adjust that allowance up by? $180 minus $110 is $70. We need to increase the balance of our allowance for bad debt by $70. So we're going to record a bad debt expense, which could go by some other fancy names like uncollectible accounts expense, but I'll call it bad debt expense, for $70. And we are going to credit our allowance for bad debt, because allowance for bad debt is a contra asset account, and like all contra asset accounts, it increases on the credit side. And here we are going to put a description in that says that we adjusted our bad debt allowance, if I could spell allowance, to its target balance. And now that we have all our adjustments on the books, we're going to have to go and adjust our T's, find our new balances to prepare our adjusted trial balance.